Okay, good afternoon, everybody. Not quite as many as normally get here. I'm afraid that we've discovered the automatic system, when you defer a webinar, doesn't send out another 24-hour reminder. But a good many people have fixed their diaries and remembered. Good to see you all here. And this afternoon, we're going to look at analytical procedures, which is always something that we try to do because it can be saving time, and we will just have to get to there and do that. Let's try again. That's the one. Okay. We'll press ahead. And we'll start with what analytical review was when I started my training, which was approximately 40 years ago. It was certainly a little while. And I can't guarantee this is a perfect quote, but this is pretty much what the assistant manager told me. He said, just look at the numbers and see if they look reasonable. And we call that analytical review. And that was pretty much the extent of my formal training in analytical procedures. It's not to say that they weren't useless procedures. We certainly did look at the numbers, and if we thought they weren't reasonable, we did something about it. But of course, things have, generally speaking, got a little bit more tricky, difficult, complicated over the last 40 years. So what do we have to do now? First of all, we have to do some analytical procedures at the start of an audit. This is not an option, we have to. Then, optionally, we might do analytical procedures in the middle of an audit. And finally, again, this is compulsory, we do some analytical procedures at the end of an audit. But there are more official names for all these. So the first one is preliminary analytical review. This is the one that's done at the beginning of the audit, of course. Then in the middle of the audit, they're called substantive analytical procedures, and a number of the slides just simply go SAP. So SAPs are substantive analytical procedures because they are substantive audit testing, but they're not detailed, they're still substantive. And finally, what the standard calls analytical procedures that assist when forming an overall conclusion, or in other words, a final analytical review. So what are analytical procedures? We have a whole auditing standard on them, so they must be pretty important. And here's part of the definition from ISO 520. Analysis of plausible relationships. Isn't it wonderful? Great word, plausible relationships. Not the way I describe it myself. Among both financial and non-financial data. So yes, we can look anywhere for possible relationships. And then such investigation as is blah, 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 blah. That's all more from ISO 520. Looking for things that are inconsistent with other relevant information or differ from expected values. In other words, something that's going to be a bit different. And how about this? This is my summary of what analytical procedures are. Comparing audit's expectations with the client's reported results and investigating significant variances. So they should have had me helping to draft the auditing standards, obviously, but they didn't. That, I think, is a pretty fair summary of what it's actually all about. And I've highlighted their expectations because a lot of people say, oh, we've done our analytical review, we've compared this to that, which might be for this year's figures to last year's figures. Whatever we're comparing the reports to is an audit expectation. And there are times when it's really important to have that in the front of your mind. Our expectations might be based on things like last year, but it is always an expectation. Okay, so preliminary analytical review, the very first part. Then, our risk assessment procedures shall include analytical procedures. This is ISO 315, not 520. And this is where it says that we must do some analytical procedures for our risk assessment. Now, our audit expectations, where do they come from? Well, the commonest one is looking at last year's figures, the previous year. Other areas that we might help look at to form our expectations are a budget. If our client does a budget, we might say that, well, we expect pretty much last year, but there'll be a bit of inflation there. So we think that in real terms, things are about the same, but the numbers may have gone up by inflation. Not so significant now, but many of us can remember years when inflation was quite a large number. Or it might be last year, the previous year, plus known changes in operations. Where will you get this? Well, partly, of course, from last year's audit. We may know things that were in the wind. Where else might we get some other information? A lot of auditors routinely look at their clients' websites because that's a good place. Where the client's telling the world what they're getting up to. If you've got a client that issues press releases, look at those, and particularly local papers. So if you're in the same area as your client and you read the local paper, if your client ever appears there, make a note of it. That's going to affect, quite possibly will affect your expectations. And then there might be management reports. There might be external things like exchange rates, commodity prices, if your client is using precious metals or steel or what have you. Interest rates, depending on our client, that might be a significant influence on our expectations. Industry information. Do you subscribe to the industry journal for your major clients? If you don't, you might like to consider it. Some firms, of course, develop a bit of a reputation in a particular industry, and they get very knowledgeable about that industry, and they can form their expectations based on what they know about the industry. I was once asked by a firm that they were auditing a forest for the forestry company for the first time, and the value of the forest had gone up by what seemed sort of gut feeling to them rather a lot. I think it was 50%. And yes, that's a very large rise in only 1 year. What I did was consult another auditor who had a bit of industry specialization and said, what are the value increases in forests this year? And They said, oh, sort of 13 or 14%. Yes, nowhere near 50%. So the first firm was quite right to be sceptical. So it could be all sorts of other things. If we have a client that, say, runs a weekend farmers market, we might want to know, what's the plan? How many stall sites are there? And has that increased? Or decreased? Because the number of stalls or the space for stalls might be a significant effect on the revenue. So we can look quite widely for information on which to base our expectations. Client reports. The standard points us to interim published financial statements. Well, I don't think the audience for this webinar is much involved with listed companies. So I imagine that amongst your clientele, interim published financial statements are pretty darn rare. But you may have a client that produces monthly or quarterly management accounts, and that might be quite useful. A common source of information for your preliminary analytical review is the draft annual financial statements. So we create our expectation and we can compare it to the draft accounts for this year. Or there might be some other kind of management data. This is generally pretty rare, but it does happen. And the really, really important thing, and it's often not well documented, is that we do our preliminary analytical review and it has to be interpreted in terms of risk. This is why we are doing it. We are doing it to identify risk, audit risk, the risk that there's a material misstatement somewhere. And so, I've seen many audit files where there's a bit of preliminary analytical review. We look at this year's draft accounts, we look at last year's figures, and it'll be okay, nothing exciting or looks all right. The conclusion on that work paper has to be in terms of risk. It might be no additional audit risks identified. That's fine, but if the word risk does not appear in the conclusion, then possibly you've not been thinking along the right lines. I think I've stressed that heavily enough now. Okay, so we'll do some preliminary analytical review. Now, I distributed last week with the copies of the slides an imaginary PAR example, PAR, preliminary analytical review. And you may have already had a look at this to prepare yourself. On the other hand, you may be picking it up just now, or you may even be thinking, oh, heck, where's that email? And what I'm inviting you to do is to look at that, which is comparing last year's audited accounts to management accounts for the nine-month period to December 2017, which have been grossed up by the highly technical basis of multiplying by 4/3. So we've got 3 quarters of the year, we're multiplying by 4/3 to get our expectation for the full year, which is okay if there are no seasonal variations. And if anyone is, whoops. Switch to, So if you cannot locate your copy from last week, there it is. I'll shrink it. There's some numbers, and we do have a discussion with the client with a bit of information on how things have changed. This is and so then if you look at the chat box, there's already one comment with we found some risk in fundraising and donations. That was quick. You must have been well prepared. You must have looked at this before. We'll give everyone else a bit more time to not being pre-prepared to read this through and say, where might there be some risk? And if you're an actual auditor of a primary healthcare organisation and you say this doesn't look right, that's okay. I've never audited a primary healthcare organisation, and it's a complete piece of fabrications. It exists only in my imagination. But it does have information that on which an auditor might derive some risks. And we have another one, well, not distributed to everybody, so a third one. Grants, as they state, they should have increased by 8%, and wages. Okay, funding of loss from the sale of investments. Gosh, yes, that might be the case. And yes, investments have indeed gone down. That is relevant to the auditor to know this. And there must be some more. It's okay. You can agree with them. Oh, thank you, Leonie, for distributing it so that everyone can read. And there are a few interesting things there, like we can audit fees. Yeah. Yes, it doesn't look as though they've been accruing this year's audit fees. And it doesn't look as though they're accounting for inventory as they go through the year either. They're still carrying the exact number from last year's balance sheet. Rent increase, question mark. Well, if we are going to rent more space in Puponga, then we would expect rent to go up. But we don't know by how much. Travel costs and wages have increased. Grant income hasn't increased by 8%, in line with the increase in expenses. Yeah, this is the kind of thing that the auditor is hopefully going to be looking at. We've done this change so that we can save on travel costs, but travel costs look as though they're going up or have gone up very considerably. And wages are up a bit. We expect them to be up a bit, but we're told that that should be offset by lower travel costs, which hasn't happened. That's an audit risk. We have to look at that because there'll be an explanation, but it might be there's a miscoding, and there's all sorts of possibilities. Because what we're seeing now, grant income shouldn't have increased by 8% on the full year, because remember, this was a September decision to rent the permanent clinic space in Puponga. So grant income has immediately increased in the last quarter. Okay, thank you, everybody. I think that's probably enough time to be devoting to this. Actually, we're not too pressed for time yet. Yeah, the things that really come out of this are where the figures don't really reflect what we're being told. You know, we're supposed to be offsetting travel costs. It might be that travel costs had been increasing because there were nurses going to Puponga so often, which is maybe it's a long way from Tukarua. They're real places, I know, real place names, but an entirely imaginary entity. But certainly the change that the client has made was to decrease travel costs, which doesn't seem to be working, and there's some additional wages, employee benefits, that's gone up by 9%, which is a lot more than the 8% for the second half year on the grant income. So we want to know about why that's going on. And good. Thank you all very much for your contributions. So we'll go back to the slides. Okay. The timing of preliminary analytical review. Well, it's at the planning stage of the audit because it's part of planning. It's part of risk identification. But, and there is a but here. Now, it might be that when we do our planning that the client does not have any financial statements. And this is actually quite common because with many of our clients, they have no financial statements except the annual financial statements, but there may be a year-end stock take to attend or year-end debtors to circularize. So our audit planning has to be before balance date. We have to make arrangements to attend the stock take, to go and circularize debtors. So our planning has to be underway before balance date, but we have no figures. We cannot do any preliminary analytical review. And this is an astonishingly sensible and I think it may be a unique acknowledgement of the reality of auditing small entities. In the auditing standards, it might be necessary to perform the preliminary analytical review only when the draft accounts are available. And we all know this because we audit small entities, that just because an audit has to be planned before balance date doesn't necessarily mean we're going to get anything sensible from the client, except possibly the date of the stock take. So the auditing standards do acknowledge that the preliminary analytical review may have to be postponed until we've got something to review. Isn't that great that there is some sense out there? Okay, now a bit of revision. Going back to the when we looked at testing controls. Our audit confidence, remember, is made up of tests of controls plus substantive analytical procedures plus detailed tests. So why do we do substantive analytical procedures? Normally, it's to reduce our detection risk. It's to build up sufficient audit confidence that we believe that we've got sufficient appropriate evidence. So we do substantive analytical procedures if we think that's more efficient than doing controls testing or detailed testing. You know, if we do substantive analytical procedures, when I did my training long ago, I could write down this year's figures and say, it might be, say, look at the gross profit margin, and I would say, oh, okay, the gross profit margin is 22%, 22.0% this year. Last year it was 21.5%. That's pretty reasonable. That's what I expected. And give it a tick. I've done my substantive analytical procedure. Cannot do it that way any longer. We now have to go and follow the 4-step method. And the regulators, I promise you know about this. Your practice reviewer almost certainly is looking for this. And step 1 is to determine the suitability of the procedure for the assertions being tested. Now, my personal observation from looking at lots of people's audit files is that the procedures are generally used in suitable circumstances, but the assertions are seldom, if ever, actually written down. What assertions are we testing? And it is a good idea to stop and think, oh, what assertions are we testing? We will think about that a bit more. Then we have to evaluate the reliability of the data that we base our expectation on. And there are many cases, and we're going to look at the 4 steps in more detail, but there are many cases when audit expectations are based on data whose reliability is charitably unknown. And then we develop our expectation. Plus, we have to evaluate whether it is sufficiently precise. And the more you think about it, the more you think that's actually pretty reasonable. Because if we have an expectation and it's got plus or minus $1 million, it's not a very useful expectation. And then, before we do the testing, we've got to write down how much variation we will accept without doing some more work. Something that was definitely not done 40 years ago. And 40 years ago, you looked at the variation and then you said, now is that acceptable or not? And you decided it after you got the answer, which of course is cheating. Nowadays, we have to write down our variation before we do the test. That's all in ISA 520, paragraph 5, a very, very important paragraph in the ISAs. Okay. Is it suitable for the assertions that we're testing? Now, this is applicable to all audit work. We should be clear about which assertions we are testing and have formed some kind of a conclusion on whether or not the test is going to, hopefully we'll have designed a test that will actually give us evidence that relating to that assertion. So, but we must be clear about which assertions we're testing, and then devise tests appropriately. Let's have a look at this. No, that's right. I have to stop sharing and oops. Oh, here we are. Okay. Here's an example. Excuse me. So we're auditing fixed assets, and part of our audit procedures are a substantive analytical procedure to estimate total depreciation for each asset class. So rather than do a detailed test of recalculating lots of individual assets depreciation, we're going to look at the class totals and say, based on the class total of book value, if it's a DV capital or cost, if it's straight line depreciation, we will estimate the depreciation for the total of the asset class. Now you can select more than one here. It can be those are all the assertions that relate to a balance sheet balance. And so when we're testing our depreciation in this way, which assertions are we testing? And, okay, so we've got lots of support for two of them at the moment, and very little support, but some support for the other two, and quite a few people who haven't voted yet. Yes, I know it's not compulsory, but go on, join in, have an opinion. Yes, it is anonymous. No one but you will know what you voted for. Not even me, truly. All I know is how many votes have come in. Yeah. And people still thinking about it and exercising their democratic right to express an opinion. Okay. Any more for any more? 3, 2, 1. Enough's enough. Okay. So you should now be able to see the poll results, and the popular assertions were completeness and valuation. The unpopular ones were existence, rights and obligations. Now, I'm with you on the unpopular ones. Testing the depreciation calculation doesn't do anything to establish the existence or non-existence of the asset. And nor does it do anything to establish the client's right to use the asset, if it indeed does exist. Now, valuation, absolutely, this is testing the number, the amount at which the assets are reported, and definitely this test is going to give us evidence about valuation. I'm interested there because personally I would not vote for completeness. We've got the fixed assets register or the depreciation schedule, and we're checking the calculations on that. How does that establish that that schedule is complete? I disagree. That's okay. We're allowed to disagree. I think that the only answer for this one is valuation, but me. I'm not an examiner, and I'm not the Financial Markets Authority or indeed the External Reporting Board. So, but we'll have another look at one. And this is, we're looking at cost of sales. And one of the things you do is you estimate the gross profit for the year and compare it to the reported GP. So we're looking at the relationship between sales and cost of sales. And again, because this is a P&L item, cost of sales, there are 5 possible assertions. And now this is, forget the last one. This is a new issue. Which assertions does this test contribute to? Again, you have up to 5 votes. You can vote for all 5 if you wish. We're getting, well, it's a bit early to say. Not many votes in. Bit of a spread. Okay, more people offering their opinions. Good. Half people have had a vote. Okay, that's okay. Most people have now voted. 19 of 23. That's a good high proportion. Any more for any more? Yes. One more. 3, 2, 1. End of the poll. And okay. Now, here we've got a much wider range and a lot of support for completeness, accuracy, cutoff, and classification, but not for occurrence. Now, completeness are all cost of sales there, and occurrence are all costs, reported cost of sales, genuine cost of sales. Now, and it's interesting that we think that this is going to contribute to accuracy and cutoff, and to a fair bit classification. Now, my own vote here is for everything, because we're looking at the relationship between sales, cost of sales, and gross profit. And if there are errors of any kind, if there's imaginary cost of sales, if there is incomplete cost of sales, if there are inaccurate cost of sales, if there's a cutoff error in cost of sales, if there are cost of sales that are reported in the wrong place, each of those errors is going to affect the relationship between sales, cost of sales, and gross profit. So Bill's personal vote is that this contributes to my opinion on all the assertion levels in this case. Now, would we generally test cost of sales for occurrence? No, we probably wouldn't be. So we won't be particularly interested in that. We're testing a debit, so we're testing for overstatement, not understatement. But nonetheless, if there were an understatement, then this test is going to be affected. The final relationship between sales, cost of sales, and gross profit is going to be affected by that. Okay, I hope that that all makes sense to people. If you want to ask a question, you can use the Q&A or the chat, whichever you wish. So back to I think you can see the slide now. Okay, now reliability. If we are basing our expectation on rubbish numbers, we're going to get a useless expectation. What can we say about reliability of data? Well, first of all, if audited data is nearly always more reliable than unaudited. So if we can base our expectation on audited information, that's probably the best that we can do. Then reliability of unaudited data, that's affected by a number of things. This is probably not a complete list, but first of all, there's the competence of the preparer. So who has prepared this unaudited data? And remember, this might be from internally by our client, or it might be from an external source. It might be from an industry journal. It might be bank's compilation of exchange rates. There's all sorts of possibilities here. And so, yes, we would think that bank would generally speaking, be pretty competent to prepare a list of exchange rates. Then the independence of the preparer. Now, if it's from an external source, like the bank, great, big tick for independence. If it's been done by someone in the client's organization, or someone who is beholden to the CEO for some reason, then okay, the independence goes down, the reliability goes down. Is it consistent with audited data? So we might not have audited this particular information, but we might have, say, totals that relate to something else. Is it consistent with what we do know? And then, of course, its complexity and the likelihood of there being an error in it. And you can probably think of other things that will affect the reliability of data. And remember, we have to do this, so we have to document it. It's very, very rare to see an audit file that actually documents the reliability of the information. Although there are some firms that are working that into their standard SAP work papers. And so we'll have another. Here's one. This is pretty subjective, I know, but it's actually a situation I've encountered quite often. And audit looks at the provision for obsolete stock, and they grab the client stock aging report, and they say, oh, okay, so either there's lots of old stock or there's hardly any old stock, and they base their conclusion on that. So we're told that we've done some detailed tests of stock purchases and sales, and we found no errors in the recorded date of stock movements. So do we regard this report as? And question part one is packaged software, and part two is if the computer software was written in-house. This is not common with small and medium-sized audits, but it's worth thinking about. And yes, this is entirely subjective, and I know that there will be, you can, but think of it in terms of one of your own clients, if you've got one in this situation. And see how would you personally relate the reliability? And the great thing about this is there can't be any wrong answers. Okay, now these people are beginning to make up their minds on this. Still a fair few votes still to come in. Oh, come on, that's so. Oh, there's 16. Yes, yes, opinions are being formed. That's okay. We'll call that enough. 3, 2, 1. Last chance. And okay. So first of all, based on packaged software, most people felt that it was fairly reliable or very reliable. Fairly reliable got the biggest tick. Now, what wasn't stated explicitly, but it wasn't stated that we've done it, so I think it should be fairly obvious that we've not actually tested this report. We've picked up an aging report, but we've not actually done any testing to establish our own view on its reliability. And so this is a question of, well, why would we rely on it? My own view is that packaged software is, generally speaking, reliable, because if it's a package, then it's written externally. No one, and the authors of the software have a huge imperative to actually make it do what it says it does. So if they write a report and they do not age stock correctly, then they will lose business. So I think the packaged software is generally pretty reliable. Now, I don't know any auditor in any firm of any size anywhere who has rechecked the ability of a spreadsheet to do arithmetic, and that's packaged software. I know lots of auditors who take the client's spreadsheet and re-add it, for example, put their own formulae in to make sure they get the same answer. But they're still relying on the spreadsheet software to do calculations reliably. We think it's extremely reliable. Excel wouldn't sell a single copy if it couldn't add up. So with packaged software, yes, we have pretty reliable. We can probably place a fair bit of reliance on that. If it's written in-house, interestingly, no one rated it as very reliable. Some still thought it was fairly reliable, but there was a definite, the average definitely shifted down, and I would probably shift it down a bit more than that, because there's the possibility here that the software will be manipulated to give a stock obsolescence report that the client wants the auditor to see. And the solution is, of course, to do some detailed testing on the accuracy of the report. But we seem to have, anyway, a general agreement that it's because it's written in-house, it is less reliable. I agree with that. And then, as I say, it's a matter of professional judgment and lots of circumstances, just how reliable it is. So we have one very skeptical auditor who, even with packaged software, thought it was very unreliable. And of course, if we do test it, then I'll test the report and find that it's accurate in our test, then our assessment of reliability goes up even higher. Okay, right, and back to the slides. Now, evaluation of precision. Yes. Now, how do you look at the precision of your estimate? So, well, first of all, we'll look at what might affect the estimation of a gross profit figure. So we have we've estimated gross profit. It might be, we've got yes, we've got $500,000 of sales. We expect gross profit to be 20%. We've got $100,000. So how precise is that? What's going to affect the precision of our estimate? And please use use chat for that. You haven't been able to prepare this one in advance, so it will probably take a time for some cynicism. No, I'm cynical enough for everybody. Unusual events. Yeah, they would get in the way of a gross profit. Yes. Stock valuation. Yes. What else is going to affect the accuracy, the precision of our estimate? And getting, most of these are going only to me. Stock valuation, prior year pattern versus current year conditions. Yeah, there could be all sorts of things that are a little bit different this year. It could be exchange rates if we're importing or exporting, importing raw materials, exporting goods. What else is going to affect gross profit? Markup percentages. Yeah. Do we still have the same pricing policy? Debtors cutoff. Bad debts shouldn't affect gross profit because they would be an expense, not part of gross profit. But debtors cutoff certainly is going to affect gross profit. Any other thoughts? So what about sales mix? We might have one department moving ahead, another one contracting, and they've got different gross profit margins. It could be general economic, no, it won't be. It could be competition forcing prices down, or competitors that we've driven out of business, meaning that we can put our prices up. Yeah. And for primary producers, when we Yes, primary producers. Oh no, that's cheating, Dave. Because everything affects their gross profit. Weather, yes. Yeah, how much they grew, what the market rate was. Yeah, how badly the Japanese want that particular product. So, but the important thing is that there's a whole heap of things that are going to go into estimating the gross profit figure. And oops. So now here's another one to scratch your head over. So think of one of your own trading clients, yeah, and scale it up or down so that gross profit is about 100,000. So and think of this particular client, and bearing in mind the variables that go into your estimate of gross profit. So if make your client bigger or smaller so that you're expecting gross profit to be 100,000. What's the range that you think it would then lie in? Which you may do by calculating in some way, or you might just put a wet finger in the wind and say, so you think of a particular client. So there's no right or wrong answers because we're all thinking of a different situation. But think of a particular client, you've estimated gross profit, what's the variation in that estimate? What's the range of reasonable possibilities? And to say there's no right or wrong answer because everyone's thinking of a different client. And it's interesting. But we're getting approximately a sort of a bell curve, roughly. So we've got a client that's got sales, it's got cost of sales, it's got gross profit. If the gross profit was, if you estimated the gross profit at 100,000, how? So, in which range would you then say that expect the exact number to fall? Any more? Most people have had a go. Any more for any more? No. And yes, one more. Okay. And okay, most people have said between 90 and 110,000. So plus or minus 10%. That's what I would have expected, but there's all sorts of variations in businesses. Two people within 1%, they think they could estimate gross profit within 1%. That's fantastic if you can, but there are businesses where you can do that. And a few within 5%, a couple, no, more than 10%, more like 20%. And of course, if you can't estimate it within 50%, it's not worth bothering, is it? Okay. Now, I bet no one did that by sitting down with a calculator and thinking, oh, there's this range from this variable to another variable and so on. And now, what do you reckon? So we do our estimate and then we look at the range. And if the range, suppose the range was 20,000 or 80 to 120,000, sorry, 20%, which is 40,000. If that's greater than performance materiality, is it worth doing the test? So if we think that we look at a test and it's got, you know, a wide range of, fairly wide range of precision, if the range is greater than performance materiality, are we going to get useful information? Okay, well, we have supporters of both. Yeah, people scratching their heads. Mm-hmm. And the answer is not in the auditing standard that I can see. And okay, that's yeah, that's oh, a dead heat. Yes, came with a rush at the end. My vote is no, because if we do our test and then we say, oh, the answer is going to be within this range, and that range is greater than performance materiality, I don't think we've added anything. Remember, we have to gather our audit evidence. We build it up with tests of controls, SAPs, and detailed tests. How much is the SAP going to add to our confidence if the precision of our estimate is so low? Why would we bother? Yeah, so it was interesting watching the boats come in. And No had a strong lead early on, and then there was a rush at the end to say to vote for yes. You might say, well, if I do the test and it comes outside even those outside that huge range, then we've still got something seriously wrong. Yes, but I would hope that you could also determine that using other testing. My concern is that if we do the test and it's successful, and the reported figure is within the range, and what have we added to our audit confidence? And I don't think it's anything. Okay, so that's me. Okay. Oh, that's right. I put it on a slide and then I wrote the poem. And so determine the variation acceptable without further investigation. So this is saying how far away from our estimate are we going to accept? Well, remember how we built audit confidence. So what we can say here, because there's actually no single answer to this, but the greater the variation we will accept, the less reliance we can place on the SAP. Now, if we can produce an estimate and say we expect the real number to be within 1% of that, that's great. That's a very small variation. We can get a lot of confidence from that test. If we have a wide range, this could be between a range of 40%, Yeah, that's not a lot of reliance. So it's more variation means less reliance, less variation means more reliance that we can put on that. Now, somewhere no, I don't have it ready. Shame on me. Exit out of that and okay. Somewhere on this disk. Okay, and here is a work paper from the practical auditing, and it's difficult to have a work paper that will look at all substantive analytical procedures, but this one at least does have the necessary requirements. You know, it makes sure that you go through the right steps, the 4 steps. Okay, so using the estimate of depreciation expense based on asset class totals as an example, which assertions are we testing? We're testing valuation and the reliability here. Now, the underlying data is the client's depreciation schedule or fixed assets register. And we haven't tested the detail because we're doing the SAP to avoid doing that, but we can say that the totals are consistent with the audited ledger. I can't type, I know that. So we can look at reliability here. We've got some reliability. We know that the totals are consistent with the ledger. We know that we've audited money coming in, money going out. We have some confidence that the ledger is pretty good. Now, the precision, and here, I mean, to require the auditor to evaluate the precision, I think means that this bit was done by someone who's never actually done any auditing. Because I've seen one example, it wasn't from the International Accounting Standards Board, or no, whoever does the auditing standards, but they said, oh, maybe we've got two rates of commission. There are some clients are at we pay a commission of 5%, and some we pay a commission of 8%. And then they said, well, the precision is between 5% of sales and 8% of sales, which is totally unrealistic because in the real world, there'll almost certainly be some clients on which there is no commission paid at all, say other members of the same group. And so you're saying that there might be the case when all the sales are at the lowest commission rate, or they might be all at the highest commission rate. And the answer is that just doesn't happen in the real world. And so if we look at depreciation calculations, say plant and machinery, we might have depreciation rates that go from, say, 6% to 48%, because we've got one highly depreciable item and 2 or 3 very low depreciation items. But most of them are in the range sort of 18 to 22%. So we have to then say, well, we could say the range is between 6% and 48%, but that would be totally unrealistic, because we know simply by eyeballing the depreciation schedule that we've got, as last year, a whole range of depreciation rates in this asset class. So we can say that we might say, well, there's our expectation is that we will be within 10% of the effective depreciation rate will be within 10% of last year. Okay, so it might be last year percent plus or minus . I'm making this up. There's nothing in the standards to tell you how you evaluate your precision. This is an example of how I would do it. So last year's percentage might be, the average was, say, 20%. So I'm going to say I expect it for plant and equipment, between 18 and 22%. And because most of our clients are small enough that we can eyeball the total register, if there's been a major additional disposal, we can adjust that for that. So how much of a difference are we going to record without further investigation? And this, I think, it doesn't say it has to be done in dollar terms. It's usual to use dollar terms, but I don't see why we couldn't say that we're going to say that we'll do no more work if it is indeed within our 10%. But we might say, well, we're expecting it's going to be, but if it's at 10%, it's not unexpected. That's within our precision. But we actually, if it's only 10%, then we need some more evidence from somewhere. So, we'll say at 5%, we'll say we've got enough confidence. We don't need to do any more detailed testing. If it's 10%, well, we don't think it's wrong, but we're not confident enough. So we might do 1 or 2 detailed tests. So then generate the estimates. So we do the work, done, initials, and then obtain and verify explanations. Oh, we haven't done that yet. Let's go back to the slides. And whoops. Something very strange here. Excuse me. Try again. Okay, you should now be seeing a slide that says if the variance is too great. And the standard does tell us what we've got to do here. Number one is inquire of management. Dear management, I thought it was going to be within this range, but your accounts show this number. Why? And then management will say, well, that's what it is. Then we obtain appropriate audit evidence for management's response. Highlight that. We do not just go to the client and say, what's the reason? And they say, oh, yeah, we've got, we had the widget crumbler broke down, and we had, and the first guy came to fix it, did fix it, we paid him, and then it broke down again a week after that, so we got someone else and they fixed it properly, but that cost twice as much, and blah, blah, blah. And you say, oh, yeah, that all sounds reasonable. But we don't say, oh, that's reasonable, and stop. We then get appropriate audit evidence. And in the case of the repairs to the widget crumbler, it might be going and looking at the invoices from the repairers. So just inquiring of management is not enough. We have to go and check what, go and get some audit evidence, and indeed perform other procedures if we think that there are other procedures necessary. So a pretty simple concept, but I'm afraid that getting that audit evidence is not something that in my role as a reviewer, I always see. It's quite common to ask management. Management gives a reasonable explanation. Yeah, that sounds pretty right. Stop. No, the audit doesn't stop. They go away and check management's explanation. So, and that is the 4-step method. It's taken up a fairish bit of time, hasn't it? And then we now get to the final analytical review. So we have to do some near the end of the audit. And here we want to form a conclusion as to whether the financial statements are consistent with the auditor's understanding of the entity. So we've got to do something near the end. What do we do? Well, one size does not fit all, although the commonest thing is to once again compare with last year. Another, and I think rather better common approach, is to do some analytical review at the conclusion of each section of the audit file, so that when we think we finished debtors, and we do a bit of analytical review on debtors. Do they represent a reasonable number of days sales or whatever it might be? So you do that on each section, and then a final helicopter view of the complete final financial statements. I think that's a very, very sensible approach. And the objective is to answer a question. And the question is, do these financial statements as a whole make sense? And that's all we have to do for our final analytical review, because it's that helicopter view, the big picture. We're doing, we go through the audit, we do a lot of detailed work, we look at debtors, we look at stock, we look at creditors, etc., etc. And we're pretty sure that all the individual numbers are right. But put them all together, do they still make sense? That's what we're trying to do. And one last. last opportunity for you to express an opinion. Now, this is not uncommon in auditing small entities. The client provides full draft financial statements before the audit is planned. It's one of those, we don't even start create the file until we've got the draft accounts. And so our planning analytical review includes comparison of the draft financial statements with our expectation, whatever our expectation is. And then we do our audit, and there are no adjustments to the draft accounts. So can comparison with last year be acceptable preliminary analytical review and final analytical review? And you have 4 choices there. It could be yes, it is, no, it isn't, or conditional. Yes, but the conclusions may be different. Yes, but the conclusions will be different. Now, this isn't in the standards. This is a question I've drawn up to provoke you, hopefully, into thinking. And we're getting the early few votes are spread around a bit. It's okay. Yes and no. Yes, yes, but no. We normally get a few more responses than this. Come on, one more and then we'll finish it off. Go on. Have an opinion. It's anonymous, we don't know. There's the last one. And the most popular one was yes, but the conclusions may be different. Now, in general, I would say that yes, the comparison with last year's audited accounts, may be a reasonable expectation in both cases. So I personally would eliminate no. I think that there are plenty of times when basically using last year is going to be fine in both cases. Is it a simple yes, or is it a qualified yes? I go with the majority here. I think it's a qualified yes. And the conclusions may be different. Well, they're certainly, I think, going to be expressed differently because we're looking for different things. In the preliminary analytical review, remember, we're looking for risk. And we might have some risk, or we might say, no, that there's no special risk, but our conclusion at preliminary analytical review will be in terms of risk. And at the final stage is, do these financial statements make sense? Now, it might be that if there is a question that arises from the final analytical review, that, if you want to split hairs, that's evidence that there's a risk that there is a material misstatement lurking in the financial statement. So it's still about risk. I mean, the whole audit is about the risk of material misstatement of the financial statements. So the conclusions may be different. I don't think they will necessarily will be different, but I think they are likely to be expressed differently because the first must be in terms of risk. The second one can be that the financial statements are consistent with our knowledge of the client. So it does effectively mean the same thing, that we have addressed all areas of risk, but it would be expressed differently. Is that now, so is that a different conclusion, or is that the same conclusion written differently? I'm not going to get into that. I think that everyone who said yes, but is in the right area. And that I think is it. Any questions? There's nothing in the Q&A. So apologies again for postponing this webinar. The underlying problem I have is gallstones, and most of the time that's fine and it will be fixed. I've got a date for the operation, but last Tuesday I was very ill, and I think I made the decision to postpone rather than my wife, but she certainly supported it very enthusiastically. And as it happens, with Cyclone Gita, I'm delivering the broadcasting from John Murphy's office. What does he call it? Superior Business Accounting or something. Can't remember his name. The name of the practice. In Motueka, and I almost certainly would not have been able to drive home afterwards. The roads around here got, you may have noticed on the news, they got pretty badly dealt with. So thank you for those folk who sent get well messages. That was very kind. I hope I've acknowledged them all by email. So the next webinar is in only 2 days' time, 1 o'clock on Thursday. Thank you, David. And so yes, there will be some material goes out tomorrow, and we're actually going to be finished before 5 o'clock. Whatever has gone wrong. There's a chat that I didn't pass on. Someone who would not use substantive analytical procedures for gross profit unless I could get to within 1%. Yes, actually, I agree, John, but GP was a fairly simple concept to use for the example. I wouldn't normally use an SAP to audit gross profit. Although, of course, 40 years ago, we did every audit. We looked at the gross profit percentage and said, is this right? Okay, thank you all for your attention. I hope you've got stuff out of that. This is recorded, of course, and the recording link will be distributed within about 24 hours. If you don't get the links, you should get an automated email. Whether you attend the live presentation or not, you should get an automated email about 24 hours later with the link. If you ever don't, get back to me, I can give you that. Okay, so we all get home on time. Great, thank you very much indeed for your attendance. No more questions. Bye. Goodbye, see you in 2 days.